Hey there, hope all is well. Back at you today with some more RT News updates. And as you can tell from today's title, High Risk, a look at the globally systemic important banks. I'm going to be covering a couple articles dealing with, as you see, the biggest banks in this country that surround me right now and how they are labeled as globally systemic, but yet they pose a real risk in regards to just the everyday lives of citizens who choose to bank with these institutions. And so I have a couple articles that I want to share with you, just highlighting some things that more people should begin paying attention to, being that these banks here are the backbone / the foundation of our economy. And pretty much every monetary policy that the Federal Reserve will implement has to do with making these banks more sustainable as well as profitable. And so I wanted to get into some of those articles. But as always, if you're new to RTD, I want to encourage you to click the subscribe button as well as the notification tab to be informed whenever I do updates or interviews. And also, if you find these things, these conversations to be thought-provoking and informative, I want to encourage you to share these with your family and friends so they themselves can become more aware on matters that do impact them and affect them as well. And also, I want to encourage you to visit the Rethinking the Dollar University page, where I have put together all my prior interviews with various guests, including authors, economists, professors, you name it, where they share their thoughts on what it means to rethink the dollar and why more people need to begin really taking an interest in this subject matter. So let's get into today's articles. All right, so today, as I mentioned, I have a couple articles I want to share with you. I want to be short and concise with this, but yet give you an idea of what's going on and why you should start paying more attention to these globally systemic important banks around me. So these 8 banks that surround me right now make up as I mentioned, the backbone of our economy, because they hold majority of the wealth of the citizens of this country. So there's approximately 320 million, 330 million people in this country, of which majority of those people do banking or of some kind through these institutions. And so these institutions have grown so large, especially since the financial crisis of 08-09, to where they've become even too big beyond what they were to fail originally back in 2008, to the point where now it's kind of going to create some type of systemic risk for everyone involved, and especially you if you are banking at these institutions. And so I have a couple articles here, as I mentioned. I want to go through them, but basically this all stemming from the recent open board meeting that I actually watched a week ago, where the analysts from the Fed were giving an update to some of the board of governors. And just after listening to some of the questions, it really got me to thinking about how unorganized and how much they don't really have a game plan for how this thing is going to play out if these banks around me begin to experience some type of problems, of which I'm actually going to point to one of the banks now that's having some problems. It could be some type of systemic risk, because they're labeled as having 5 risk. That can be problems for that particular bank. And then you'll see eventually how all these banks are interconnected due to derivatives and all types of other contracts they have going on amongst them. So let's get into those articles. I want to just thumb through them briefly, give you some thought, and let you chew on the rest of it for yourself. But here's an article that came out today from Mondak, financial news outlet. And so some of the things, it kind of summarizes that meeting I mentioned last week with the FOMC open board meeting, and give an idea of some of the conclusions that came from that meeting. But it says on September 1st, the Federal Reserve voted to adopt a final rule requiring U.S. globally systemic important banking institutions, or G-SIBS, and the U.S. operations of foreign G-SIBS to amend qualified financial contracts, or QFCs, to limit counterparty termination rights that may rise from the failure of a G-SIB. So basically, they're trying to find out a resolution on how to calmly unravel some of these problems that these banks are going to have. It says the rule is intended to facilitate the orderly resolution of a G-SIB by limiting the ability of a firm's counterparties to immediately terminate QFCs upon the commencement of a bankruptcy or another resolution process. It says the final rule, which was first proposed in 2016, contains 2 primary provisions. First, it requires the inclusion of contractual restrictions on the exercise of default rights. It says including a stay period after the commencement of a receivership, insolvency, liquidation, resolution, or similar proceeding. So basically, just to summarize that up from what I've gathered, is that once something goes wrong and they recognize that there's a problem, they're going to put a stop or a freeze on that institution's activity so that there cannot be a bank run. And that was something that they discussed in that open meeting, and the question was brought up, can they actually do that, and how long do they recommend? And the analysts gave the recommendation for a 24-hour period, of which that lets me know that 24 at a minimum is what they think they can do, because they've never dealt with such problem as they say, QFC and all the risk with that, it's good to say it'll probably be longer than 24 hours, which will cause those that are have deposits in those banks to probably panic and want to go to the ATM and withdraw their money, which could actually lead to a longer period of time than the 24-hour period that they recommend. And then it goes on here to talk about the second provision. It generally prohibits QFCs from containing cost default rights against the G-SIB and its affiliates. So the next article I want to show you is actually from December of this past year, but it's still relevant because it gives more insight as to how the G-SIBs, or globally systemic important banks surrounding me, are supposed to be how they're supposed to be capitalized to be able to handle some of the events that could cause a financial problem. It says here are the U.S. Based global systemically important banks, and then it goes through giving a little detail here. But one thing that stood out in this article here, it says just how much extra capital do these banks have to hold in case there's a problem. And it says when the rules were first published 2 years ago, JP Morgan Chase faced a stifleless penalty with a 4.5% surcharge relative to its Tier 1 common equity. And so I did a little research on that, but it's kind of complicated, so I'm not going to get in that. But it says Citigroup was 3.5%, Bank of America, Goldman Sachs were 3%. And so it'll go down and gives you a graph of how the original G-SIB buffer was a lot higher. I'm assuming this was probably, a while back. Whereas as of right now, they've shrunk a little bit, which kind of indicates to me that they've probably grown a lot larger, which means they are not holding as much capital as need be. But even though this past summer they had the Federal Reserve did the stress test, and apparently a lot of the banks did extremely well with having enough buffer or room to wiggle. So they began paying out dividends and things like that to shareholders and stockholders and things like that. So it goes to show how, of course, they probably fudged some of those numbers for that. But once again, to give you an idea of where these G-SIBs stand as of December 16th in regards to the ability to be able to manage, with having a little bit of buffer room or capital to begin handling some of these risks, which clearly 2.5%, and being that these are the biggest banks in our country, it's not really a lot of wiggle room to be able to sustain themselves if something was to happen. And so that leads me to the very next article. Here is an idea of what I actually wanted to point to, was that when it comes to the QFCs or derivatives, which are the biggest problem that these banks face, and those are just, all types of swaps and financial contracts amongst themselves, pretty much a whole illegal gambling ring amongst the banking sector. But give an idea of how large it is and how much of a problem it was in 2008, because during that open meeting that I actually watched, it mentioned how they are taking their studies from Lehman Brothers and how it unfolded as a way to kind of measure and prepare for what could come with these G-SIBs down the line. And so it shows back and says Citigroup had more than 4,700 U.S. bank combined after blowing itself up with derivatives in 2008. So it says it gives an idea of the countdown on the total derivative count that these banks, these G-SIBs, hold. And from 1 through 8, it says, let me see, $55 trillion for Citigroup, and they hold 1.8 trillion in assets. And then it goes down the line, JP Morgan Chase 2.4 trillion, but they are exposed to 52 trillion. So all these banks are way over leveraged as far as what they are on the books for being a part of and what they're actually able to kind of sort of be able to handle if something was to happen. So at the end of the day, just give an idea of what's going on here. These are the top 25 holding companies in derivatives in here in America. And so a total of $250 trillion. And that's just, what we have as of this particular article. How is this, why is this important to you? You might want to know. But yet it says Deutsche Bank is systemically the most important bank. And what really stands out is this famous graph of how interconnected our banking system is. So here it talks about the systemic risk of all G-SIBs are on the planet. And Deutsche Bank in Germany is the biggest and most dangerous, I might add, because they've been having problems over the last year that you won't hear about much in the mainstream media. But yet they're in the middle, and here's the G-SIBs surrounding them, and they're all interconnected. All these banks here are intertwined with their financial practices. And so the main issue for Federal Reserve Bank is to make sure that these banks, primarily the ones they're overseeing or the primary shareholders in the Federal Reserve charter banking system, are sustainable if something does happen. And I want to wrap this up with a recent article that is quite telling of how the risk goes well beyond just the derivatives and things like that. So here's an article from Los Angeles Times that is from actually a couple days ago, over the weekend, and it talks about one of the banks that's included in the G-SIB category, and it's Wells Fargo, and how I'm sure you may be familiar with the scandal from last year, how they made all of those fraudulent accounts. But yet this really hits home to everyone who may bank at one of these institutions, because it says it's been a year since the Wells Fargo scandal has broke and new problems are still surfacing. And so it gives a little bit of what's going on as far as how, 2 million accounts, 2 million customer accounts are fraudulently created, and how they use it to basically make profit, and they kind of force some of their employees to kind of go along with it so that they can meet their numbers and so forth. And it goes on from there, and it talks about at that time, September 2016, Wells Fargo admitted to fake accounts fiasco and agreed to pay $185 million. The CEO had to step down, yada yada. But some things that really stood out to me is, on the idea of risk, and watching the FOMC meeting, how risk was a primary thing they were talking about. And it talks about here what's still developing with this Wells Fargo scenario. And I'll be willing to bet that Wells Fargo isn't the only one of these G-SIBs surrounding me that's involved in activities of this nature that we just don't know about. But it says a bank the size of Wells Fargo, which has more than 250 employees, has boasted that it does business with 1 in 3 Americans households. So 1 in 3 American households do business with Wells Fargo, and they're boasting about that. It says it's bound to uncover problems if it goes looking for some. And then it goes down a little further. It says the internal report published in July of this past summer lists 5 high-risk issues, all identified by the bank itself. Then it says Wells Fargo officials, included Mac and Vic Albert, risk officers for the community bank, declined to comment on the report. But they said the issues categorized as high risk in reports to the community bank's risk community would generally include those that might be widespread, affect customers, or have regulatory ramifications. So these could be some widespread problems that go well beyond Wells Fargo or intermix with other banks, and it will affect customers, and it could have some regulatory problems. And so this is just, some of the things they're talking about. But I wanted to hit on these things just because I wanted to highlight some of the things that aren't really being talked about when it comes to G-SIBs or the globally systemic important banks, and how they impact you, the viewer, and your family and friends, because everyone, tend to bank with these, these banks because they're more well-known, they're more popular. But also, I just want to wrap this up and leave you some thoughts on the idea that, being that these banks are too big to fail, they pose systemic risk to your life as well as to mine. One of the questions I want to ask you, do you continue to bank with these institutions knowing the risk they have? And then also, if you know better than to bank with these institutions, or you don't hold as much of your wealth in the hands of these banks here, do you tell your family and friends about how these banks are basically systemically, dangerous to their financial health as well? So just wanted to shine a little light on these banks here. There's a lot more to go into, but yet I want to leave something on the surface for you. Ask a couple questions. I would love to hear your thoughts on these institutions here. Is this something worth taking a deeper look into? I believe they are. So other than that, leave your comments below. I'd love to hear your thoughts on these banks here. Look forward to bringing you more news. Thanks.